Hello and welcome to another video. My name is Zexa, and in today's video we have another stock analysis on Analysist systems. Now we'll do it like how we always do it on these. We'll have a look at the company, what it does, a bit of background. Then we will head over to Simply Wall Street and do a bit of analysing of the company. Then it will be on to Yahoo Finance or whatever to do the financials, income statements, balance sheet, that type of thing. And then finally it will be Trading 212, looking at some little bits on there, and then the conclusion to wrap it all up. Without further ado, let's get into it.
I fight to live, I fight to strive. One day I'll have what I want in life.
Okay, so now we're on the B&E Systems website. Now this website is actually quite good for a company. It shows you quite easily what it does and has a lot of investors tools. Now we're in the what we do section, as that's exactly the question we want to answer. So you can see that in the air segment, land, future technologies, cybersecurity and intelligence, electronic services and sea. So obviously they're across the entire range of military practices, as they should be, but they're also in other things like cyber and security. They have things to do with space, and they have things to do with renewability, sustainability as well. So in essence, their whole objective, or their main objective, is to deliver equipment to the Army, the Navy, Air Force, and they just want to deliver the best possible equipment they can to give edge when it comes to military engagement. Now, humans are a species, love to fight, so more and more money keeps getting added, and if you look at any country, a big percentage of their money goes into their military. Alright, so straight off the bat you can see that there is no risks, which again is a nice surprising thing to see. You don't often see it. We won't look too much of that there, but we can look about the company. If you want to read this, you're more than welcome to. Founded in 1970, so it's been around for a while. Provides defense, aerospace and security solutions worldwide. Like I said, electronic systems, cyber intelligence, that's a big one they have. Okay, coming down to the first section, you can see that this company is undervalued. This is a UK company, so it will be in pounds. So you got £5.50 calculated, that's the current price, and then £9.94 is the fair value price. So if you can pick it up now, it's a good time to buy according to this analyst. Now this does the two-step discounted cash flow model. You can click this view data and it will tell you how it's broken down into there, how it gets calculated. So you can have a look at that if you're interested. So that's one first tick for this company. Price to earnings ratio is good. We've got the company down here, and then you've got the industry. So it's a lot better than the industry and better than the market. So another tick. Price to earnings growth is poor value based on its PEG ratio, so it's a bit of a slow grower. You'll also see this later with another metric that I found. I can show you that. Price to book is overvalued based on its PB ratio compared to the Great British aerospace and defense industry, but not by much. Like industry, company, not really a problem there in my opinion. Future growth, so obviously it's important to see where the company is heading. By this, it looks like it's just going to be a bit flat, not too much growth. That remains to be seen though. Obviously we don't really know what the future is going to hold, so we'll have to wait and see on that one. Yeah, and a negative with this company is its future growth is predicted to be slow. However, again, it's just analysts, they're predicting. No one knows what the company's going to do, so you can look at this, but again, no one really knows. One of the negative sides of this company is the analyst future growth. However, you don't know if that's right. No one knows how the company will perform in the future. You can only sort of make assumptions based on the past and based on current events. So again, this, you just look at how you wish to look at it. I don't focus on it too much personally, but again, it's here if you want to look at it. Going down to future return on equity, that's going to be considered high, better than the industry looking here. That'd be nice to see if that happened. Again, that's future, we don't know. Past performance, however, we do know. So look at this, put on free cash flow, all these. Now this company has just remained a bit kind of flat throughout the years. It's not sort of gone spiked growth, just remained a bit stagnant. So historical annual earnings growth 12.5%. It says there's a high quality earnings and that EA's current net profit margins 9.1% are higher than last year, or 6.4%. So in the past there has been some growth, not ridiculous growth looking at this, however still some. Past earnings growth, you can see past 5 years annual earnings growth and last 1 year earning growth. So the past 5 years the company's done a lot better than the industry, last 1 year the company's done a lot better than the industry. So it's kind of weird to see how it's beaten the industry both times, yet going forward they don't predict this to be the case. So it's kind of strange how history has proven one thing and people are analysing or predicting another. But hey, that's investing for you. We saw that earnings have grown by 12.5% per year over the past 5 years. Accelerated growth, earnings growth over the past year of 45.7% exceeds its 5-year average of 12.5% per year. And industry earnings versus industry, earnings growth over the past year 45.7% exceeds the aerospace and defence industry at 13.6%. Not sure why the last year earnings for this company were so amazing compared to industry. That would be something you'd have to look at deeper if you was actually going to invest in this company. I would suggest that anyway. Return on equity is high, 26.8%, and then you got industry here. So past performance is a tick overall so far, and it carries on with return on assets and return on capital employed. Return on capital employed not as good, quite close to the industry there, or that quite close as 3 years ago. So he has done a bit better managing it, but not so much, so you would like to see this a bit higher. Alright, coming down to financial health. Now this is an important one in terms of how the company's going to be able to manage debt and whatnot. So you can say short-term assets just about outweigh their short-term liabilities, and it's just under the long-term liabilities. However, the long-term assets outweigh the long-term liabilities. So it's not a terrible balance sheet. They can pay off all their little liabilities, short-term liabilities. So that's good to see. They won't have much left over, however, so you'd want to see this higher than both of these. That'd be nice to see, but it's not a terrible balance sheet. I've seen plenty worse. Now down to the debt to equity history. So we've got debt, equity, cash and equivalents. So we can see that the equity in 2018 was higher than the debt, and it's gone forward until sort of 2020, 2021, middle out. Obviously you had the big cove, not going to say the word because YouTube doesn't like it. But yeah, we have sort of rebounded now going forward. That is nice to see. It is considered satisfactory, so that's nice. It's been reduced from 169.7% to 73%, which is good. Making a commitment to reduce that debt is always something that should be strived for. There is good debt and there is bad debt. Obviously, no debt is good, and if you still have the growth, then that's great. Well covered by operating cash flow, 47.7%, so no problem there. And its interest payments on its debt are well covered by its EBIT of 15.2x coverage. So not too much for a problem there in terms of debt. We'll take a look at this balance sheet anyway in the next section, so we won't focus on this for now. Now coming down to the dividend, so we can see this company does pay a pretty good dividend of 4.4%. So this would be one that I'd be more interested in for upping my dividend yield on my personal portfolio. However, there is another issue that I found while looking at Train 212 that I'll show you about. There's notable dividend and it's a higher dividend. Coming down here to the growth, earnings per share on. The dividend per share has been growing over the years. Actually, I'll turn this one off now, just so I can see the dividend per share. It has been growing, but only a little bit. It's quite slow growing, but that's the growth rate. Now I'll show you on trading 212, I'll just show you that later on that next step, that the growth rate is a little bit low in my opinion. Payout ratio, however, is good. Right now it's 44%, predicted to be 51% in 2024. Both of these are fine by me. Means they've still got a lot of capital left over to reinvest in the business for growth, and they can still pay their dividends, which I like as a dividend investor. There's no insider selling, no buying or selling, so that's neither here nor there. It's just neutral. And then the breakdown of the company is as such. Got public companies, individual insiders, private companies, state or government, employee share scheme, and general public. So the general public, that's me or you. We hold a very small percentage of this, 6.2%. Institutions own pretty much all of it, and then the employee share scheme. Saying this, we have not been meaningfully diluted in the past year, so that's one thing, but we don't really have much sway on this company. That's probably why the share price is quite stable. People can buy and sell a lot, it doesn't sway it too much as the institutions hold most of this, so that's up to you if it's a good or bad thing in your opinion. You'd have to probably do more research on companies that have this similar and how they sort of operate throughout the years, I guess. I just thought I'd mention that. Okay, so now we need to do the financials of the company, have a look at income statements, balance sheet. That's what we'll go on to now. Alright, so now we're on the income statement of this company. So we can go back to 2017, like always, and then the trailing 12 months. So starting off with total revenue, we can see from 2017 that we did have a decrease in 2018, then it went back up quite a lot in 2019, 2020 was a good year, and then trailing 12 months was even better. Now gross profit we can't see trailing 12 months, however we can see that in the rest of the years. So again, same trend, we've had a decrease, then a nice increase, and then a nice increase again. I'm not sure why the gross profit isn't there trailing 12 months. I don't believe there is none. So we can have a look at this maybe on Simply Wall Street, not Simply Wall Street, Trading 212, just to compare, see what it's up there. Total operating expenses, these numbers seem quite consistent. And we've had increase, 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 and then decrease trading 12 months. They probably shut down some things, I guess, maybe during the word I'm not allowed to say for YouTube, but we know what it means. And then you got net income down here. We've had, this one is an actual increase from 2017 2018, then an increase again, now decrease in 2020, and then increase trading 12 months. Again, maybe some things were shut down, reduced income, who knows. Unless he's paid off some debt or something here, because obviously gross profit was higher, revenues were higher, so you'd think that income would be higher, but it's not, so something kept happening with his money. Anyway, onto the balance sheet. Okay, so we've got total current assets, total current liabilities, and total non-current liabilities. Or total liabilities even. So total current assets, we've had increase, decrease, and increase. And then total assets, we've had increase, increase, and increase. Now comparing them to the liabilities, so total current assets here, total current liabilities, 7715. So assets were better, assets were better, assets were better, and then assets were better for that. Total assets, can that be the same? Yes, 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 and yes. So the assets have always outweighed the liabilities on this, which is good to see. Okay, so now I'll go on to Trading 212, have a look at a few of the metrics there that I want to show you, and have a look at the share price. Alright, so now we're on Trading 212, B&E Systems. So we can scroll down, we're in the 1 year view, We can see that in the last 1 year it's gone up 7.6%. Been a bit spiky up and down, but it's gone up throughout, so you can put this to the max. And we can see back to 2012, just about. And again, we've had little spikes, little drops. So it seems to go on a trend where it spikes up, drops, spikes up, drop, spikes up, drops, spikes up, drops. So this is always going to happen, go up and down, up and down. So now we're trading a bit sideways. So if I was to look at this and analyze the chart, I would say that it's probably time for a spike, I would probably say. This is in range with this drop here, basically, where the price is. So yeah, I'm not a trader, so I don't really care about that, but you can go into advanced chart and stuff. This just tells you about the company a bit. Got a market cap of 18.05 billion. Dividend yield here is 4.26. You can look here for where the company's been heading recently. The 6 month ended 30th of June 2021. Revenues increased 2%. Net income increased 88%. Just for a lot. Revenues reflect air segment increase of 6%, maritime segment increase of 10%, and HQ segment increase of 26%. Net income benefited from air segment income increase of 61% to 522 million. And it's just been going good overall. Now we want to look in all ratios for the thing I want to show you. So per share data is one thing I want to show you for free cash flow per share. Obviously we want a company to have free cash flow to pay off dividends. So it's got a dividend per share of 0.20 pence and a free cash flow per share of 0.30 pence. So it's got its free cash flow, which is good to see. Financial strength, we want to look at free cash flow here, trading 12 months, you've got 849 million of free cash just sitting about. Again, we like free cash, the higher the better. And then lastly, the growth. Now go down to dividend growth. We have a dividend growth 3 years of 2.82%. now this is what I want to see higher. If this was higher, then I'd be all over this company. I did add the last company I analysed, ASML, into my portfolio. This I'm probably going to add into my portfolio as well. However, I would like to see this better, so I'm not too sure again on that. Now for the conclusion. Alright, so in conclusion, this company I personally feel has a lot of good going for it. There's a few little bad things going against it. Not too big in my opinion. One's the dividend growth rate, I would like to see that higher. And then going forward, the analysts don't seem to think it'll grow that much, but looking at past performance, it's done pretty good, so that remains to be seen. The company itself, what industry it's in, I don't see war going away anytime soon, or conflict or that kind of thing. Each year more and more money gets put into military, so this company is well suited in that regard. I do see a transition from vehicles into things like missiles and self-guided systems and whatnot, and ultimately there's nukes. We have nukes. That's the one that'll fuck everything up if that goes on, but obviously no country wants to use that to deal with little squabbles, otherwise it's full on Armageddon there. Like I said, I'll probably be adding it to my personal portfolio. I will be doing a video on that probably in December, sort of wrapping up the year, seeing where my portfolio is, talking about how it got there and whatnot. I think that'll be a good one to do. I hope you enjoyed the video, and if you did, consider hitting that like button, subscribing, hitting the notification bell to stay up to date with all the future videos. Obviously check out all the links in the description. Trading 212, use that, get a free share worth up to £100 when you deposit £1 on that platform. Got Blockfi and Gemini for your crypto needs. Also Coinbase is another platform you can use for that. All links will be in the description. And some final things to note. One is the quality of the video. Let me know if you think it is better. I'm using a new camera now, the Logitech Brio, so hopefully the quality will be better. And secondly, I will have a new video coming out, as well as this one, on all the different altcoins. So that one I think should be an entertaining video. It'll be one of my ones I put more effort into, which somehow don't do as well as these ones. But who knows. Anyway, catch you in a bit. Peace out.
Tell me pretty lies, look me in the face, tell me that you love me, even if it's